Greetings, I'm Dr. Anup Shah. I'm a fellow chartered accountant, a law graduate, and I've also done my PhD in business restructuring strategies. In this 𝐶TC Shorts video, we will briefly discuss important tax neutrality conditions for mergers and demergers. Friends, the Income Tax Act uses the term amalgamation instead of the word mergers. The Delhi High Court in DCM Limited has held that the term amalgamation contemplates a state of things under which two or more companies join together to form a third company, or one company is being absorbed or blended into another. The Income Tax Act defines the following conditions for a tax-neutral amalgamation. All the entities must be companies, hence merger of LLPs would not be permissible. However, a foreign body corporate can be a transferor if the transferee is an Indian company. All the properties and liabilities of the transferor company must become that of the transferee. Shareholders holding a minimum of 3/4 in value in the transferor company must become shareholders in the transferee company. For this purpose, shares held by the transferee company in the transferor company prior to amalgamation are excluded. This is because one cannot issue shares to its own self. As per the Supreme Court's important decision in 𝐍𝐞𝐿𝐴, an amalgamation results in an extinguishment of rights of shares held by the shareholders in the transferor company, and hence it is a taxable transfer as understood under the capital gains tax law. However, Section 47 of the Act provides an exemption for a swap of shares, and therefore it is not treated as a taxable transfer under capital gains. The important part here to be noted is that this exemption is only for an investor in shares and not a trader holding shares as stock in trade. This is the Supreme Court's ratio in Orient Trading Company Limited. The shares issued on merger could be in the form of equity shares or could be preference shares, because the term used is shares, and here we have the Delhi High Court's decision in Telesound India Limited. However, an interesting decision was given by the Gujarat High Court in Gautam Sarabhai Trust, where it held that if shares are not issued as consideration, then the entire exemption under Section 47 would not be available to the investor of shares. So it is very important that the consideration involves shares as a result of the merger. The Income Tax Act also provides two exceptions, where in spite of there being an element of merger, yet it is not an amalgamation as understood under Section 21B. It must not be by way of purchase of properties by one company from another company, or it must not be by way of distribution of property pursuant to the winding up of a company. So only if all of these host of conditions are complied with, would the Income Tax Act treat an amalgamation as a tax-neutral amalgamation. Now it must be noted that even if an amalgamation does not comply with these conditions, it may yet go through as an amalgamation as understood under the Companies Act Section 230 to 232. It may yet be approved by the NCLT under the Companies Act. However, it would not be a tax-neutral amalgamation as understood under the Income Tax Act. Coming now to demergers, the Income Tax Act under Section 219AA defines a demerger as the transfer of an undertaking by a transferor company, here known as a demerged company, to a transferee known as a resulting company. So there is a transfer of an undertaking. In case of an amalgamation, two or more companies were coming together or one was being absorbed by the other. Here it is only the undertaking which is moving from one company to another. An undertaking has been defined to mean a business activity taken as a whole or a part of an undertaking, but not a mere combination of assets and liabilities. Now, what constitutes an undertaking is very important. The Supreme Court in 𝐍𝐞𝐿𝐴 case has held that it means a business enterprise in which a company may be engaged as gainful occupation. The Rajasthan High Court in Uma Enterprises Limited has held that a unit must be an operating one for it to meet the undertaking neutrality test. And a mere investment in shares of a company has held not to constitute an undertaking as per the Bombay High Court's decision in UTV Software Communications Limited. The other conditions for a tax-neutral demerger, the scheme must be approved by the NCLT now under Sections 230 to 232 of the Companies Act 2013. All the entities involved must be companies. So again, an LLP or a partnership firm cannot be party to the demerger. All the properties and liabilities of the demerged company must become those of the resulting company. Now here liabilities include those which are specifically relatable to the undertaking, and in case of general borrowings, it is allocated in proportion to the assets demerged. The transfer must take place at book values as appearing in the books of the demerged company, with all revaluation to be ignored. However, the resulting company, if so required, can record it as per other valuation if so required under Ind AS. Consideration again must only be in the form of issue of shares on a proportionate basis from the resulting company. Here the Bombay High Court in NOSIL Limited has held, if it is not so done, it would not be a tax neutral demerger. Shareholders holding not less than 3/4 in value of shares in the demerged company must become shareholders in the resulting company. The transfer must take place on a going concern basis. Here the Delhi High Court in Indorama Textile has held this means a business activity capable of being run independently for a foreseeable future. So the transfer must be on a going concern, a very important condition which is there in demerger, not there in the case of an amalgamation. Bombay High Court in Premier Automobiles Limited has held that certain common assets without which the unit may survive can be left behind under the demerger scheme. So it's not necessarily that all the assets need to be transferred, only those assets may be said to have been required which are necessary for the going concern and for the undertaking test. The demerger must also be in accordance with the conditions satisfied and prescribed by the central government under section 72A subsection 5 of the Act. However, as of date, no such conditions have been prescribed by the government. So these, friends, in a nutshell, are the important conditions for tax neutrality for a merger and for a demerger. There are a host of other requirements which are there and which are considerations and implications. What happens when a merger is there? What is the appointed date? What is the effective date? Which would be dealt with in other episodes of the 𝐶𝐭𝐬 video. To sum up, while mergers and demergers are important tax neutral modes of restructuring, they come with a host of important conditions. A simple slip in any one could be fatal to the entire scheme of things. So be aware, be cautious, and stay tuned for more episodes in this 𝐶𝐭𝐬 series by the Chamber of Tax Consultants. Thank you. Bye-bye.